Right. So, good evening, everybody. Good evening again. So, the last two lectures, I think we've been talking. First of all, the first one was on the IPS, more of like the legal side of things. We talk about all the various factors that we consider. And then last lecture, we talked a little more on the finance side about asset allocation. So we did went into detail on the modern portfolio theory, and then we talk about how do we diversify, how do we allocate different assets. I think we went quite deep into the type of assets diversification. So that's what we have covered. Then today, what we're doing is more towards the market. So like we are talking about capital market, and capital market, we're going to cover not only just the equity market, we'll talk about the bond markets, alternative markets, etc. Right? So there will be quite a few things that we're covering. And if any of y'all had mandatory economics course, your economics knowledge will be very useful here. Just to check, so does everyone, or is anyone, or is everyone required to take like a basic economics course here for your degree? Or is it or not, or all of y'all do not have any like economics background? Yes. Okay. That's good. So that's very good. Okay, so we'll cover a bit on the things like inflation. We'll talk about monetary policy. So basically all these affect market expectations, right? But of course, we're not going to dive in detail like your economics course. I usually like to give you all the intuition, more of like the real world aspect, right? So how do you actually see all these inflation or the monetary policy playing out, right? And you as a portfolio manager for your client, so how does it impact client, right? So it can be it's a lot more real life in the sense that you can actually see, okay, so if inflation is going up, so what should you do, right? Or what does it mean? So that's how we're going to tackle this issue of market expectation. And from there, the aim, right, at the end of the day is because of market factors, right? How should you formulate your IPS or your investment policy, right? So today is about this understanding of market factors, and all the tools that we're going to talk about today is simply just to explain or to help you understand the market more, right? So that's the overarching goal of today, right? So if you will see that we go into a lot of detail, right? But just keep reminding yourself at the end of the day, why do I learn so many things, so many techniques and all? The aim is simply just for you to form market expectations. Okay, so let's carry on. And as usual, if you have any questions, you can unmute yourself, or if you want, you can just type in a group chat, right? And then we'll answer them. Okay, let me see. I think because I do not have my iPad, so I can't. Let me see if I can. Okay, I can annotate through here. Okay, that's a bit. All right. Okay, so let's talk about market expectation. So, market expectation kind of impacts your risk and return perspective for your client. So if you know the market is doing well, what should you do? Or the market is going in the recession, like what we talked about previously, what should you do, right? And because of this market expectation, you might have some long-term or short-term kind of techniques, right? Do you long certain stocks or do you long a bond instead, right? And at the end of the day, depending on, again, I'm going back to your IPS, depending on what your client wants, you might want to try to achieve, this thing called alpha or beta, right? So last lecture, we talked about systematic risk, we talked about unsystematic risk. So we know that, beta risk is all your unsystematic component is all diversified away, right? So it's left your systematic component. So then we talk a little about alpha as well. How do you see alpha on the frontier, right? The modern portfolio frontier. And so that's what we covered. So at the end of the day, always go back to your first lecture IPS, depending on what your client wants. And if he wants alpha, then you should try to obtain alpha, right? Okay, so these are some frameworks that we can use. You can use historical records. This is just a very brief explanation. nothing to worry about. Okay. So when setting expectations, again we have to tackle the issue of first of all biases, your own biases. At the same time, some issues with, like, let's say historical data, whether the data will be replicated again, right? Whether the market conditions will be replicated. For example, like in the last 2 years, there was the pandemic, right? So this is like a black swan event. So how the market reacts during a black swan event is very different from how the market will react every day. And because of that, it will impact how we formulate our kind of expectations. And then again, I'd like to point out this idea of a psychological threat. I think we cover, like, if you notice, every single component that we cover, like IPS or the asset allocation, we always fall back on this issue of psychological threat or biases. And that's simply because, us as a portfolio manager, we are humans, right? So we do fall trap into all the various psychological trap as you see here, right? So, if there's anything at all, we should, or in any case study, right, we should always point out psychological traps, right? Because we are human, we are only human, and it's normal for us to fall trap in all these issues. Actually not stated here, right? There's this trap. So anyone knows what is the sunk cost bias or have heard of the sunk cost bias? Anyone? Sunk cost? Yeah, okay. Okay, so maybe you have heard of it, but I'd like to explain how is it applied, right? So for example, there's this bias is very common in a let's say a group gathering, right? If you guys go for buffet, right? You go for buffet, and then what happens is that, or most of the time when you go there, you always tell your friends or family, like, oh, we have to eat as much as possible, correct? Yes, correct. So yeah, I think some of you are already saying, right? But you have already paid, right? So it's a sunk cost. So regardless of how much you eat, right, it doesn't recoup the cost, right? So, but I mean, even myself, or I'm pretty sure when you go for buffet, you always think, I must eat as much as possible to make my money worth. But the problem is you're not making money worth because it's already a sunk cost to you. So why I like to bring up this very typical analogy, right, is that this psychological threat is very common, first of all, in our daily life, right? But not only that, in investments as well. For example, I'm not advocating like gambling, but in a game of, like, let's say mahjong or even like poker, right? If you know that your hand, right, your cards or your chips or whatever, it's not good. But most of the time we keep on wanting to bet on a losing hand. And that's the problem with the sunk cost bias, right? And the same thing, because for us, our brain do not realize that actually it's a sunk cost and we should move on from there, right? So in investments, it's very pertinent. So if you know that the market is going bad, right, you should take the losses or realize the losses and move on from there, even though it might be painful. So it could be easier said than done, right? When something really happened, then you might be more hesitant to pull back. So at the end of the day, for psychological traps, what I'd like to highlight is that identifying that you are falling trapped into such biases is the first step, right? After that, whether you decide to go against it or to just ignore it, it's up to you. So as a portfolio manager, do take note of, okay, if am I falling trapped into certain biases and what they are and how should I react? Okay, that's what I'd like to highlight. And not maybe so the sunk cost bias is obviously not here. It's not part of your required knowledge for this course, but I think it's quite relevant for the discussion. Okay, and of course you can always write it in your case study as well. Let me just erase this. Okay. Okay, so we have this example here about psychological traps. And so we have this analyst who has prepared the forecast regarding the current market environment. All right, so he recently gave a presentation to his managing directors on the following excerpt, noting that the year-end holiday sales has been weak over the past several years. I believe that the current expectation should likewise be muted. All right, so as you read this, you can immediately see a bit of this bias called anchoring, right? I think we chatted a little about anchoring, where you actually anchor your expectation on past information. But the problem is you do not know whether past information could accurately predict the current situation or even the future, right? So there's a bit of biases here already. Okay, so that's something that we need to be careful. So in fact, last week I had an occasion, a visit at Harrods, and noticed that the number of shoppers seems quite low. Okay, so these bias, I hope you all can see. Anyone can kind of identify what bias is this? So he actually went to the store and noticed that the number of shoppers are low. Anyone? You can just type in the group chat or unmute yourself as usual. Okay, so it's a little more like your confirmatory bias, right? You're actually trying to confirm what you think, right? So you're trying to substantiate perhaps your initial bias of anchoring, right? So if I just go and hop back, there's this confirmation evidence, right? And so this is what you're trying to do. You're trying to confirm what you have already, what you have said, right? So this is a kind of bias as well. Okay, so the last time I saw a retail establishment with this so little pedestrian traffic was beginning of December 1990, and coincidentally that's the worst holiday sales period in the past 50 years, and thus there will be no overall year-to-year growth for this holiday season. Yeah, so I think somewhere there's no real data, right? Yes, that's one of the issues as well. You are just they call it very anecdotal, right? You're like, oh, I went to see this, I went to that. So what do you base your expectation on, right? And yes, numbers, numericals, data is important as well. So these are some psychological traps that it's impacting this person's self, right? So if we just jump back to the previous slide, we can also think of a bit more of like, you think it could be like a bit of status quo bias. So basically there is no there's no one right answer. So you can actually say, oh, maybe it's a status quo bias, because he say like, oh, for the past 50 years, if certain things happen, therefore the sales will be bad, right? So it's like you're not you don't want to change your mindset, right? So could be a bit of status quo bias as well. Yeah, correct. So you just went to one establishment as well. So you're not going to like, oh, you sample like 50 establishment, right? So yeah, it could be not a holistic view. So those are some things that you can bring out in your answers. But remember that when you want to mention psychological biases, you have to use the names of the biases as well. So yes, those are rightly stated, and because they let me just highlight. So I think you all can't see my mouse, so you can only see what I draw here, right? Let me just see. Oh, you can see my mouse? Oh, okay. Then I will not draw them. Okay, let me just erase. Can see. Okay. So if I move my mouse, you can see, right? Yeah, okay, perfect. Hey, thanks. Okay, so yes, so just now you mentioned about data and all, right? So these are some issues, like in the data you're not collecting all. But what I want to remind is that whenever you mention psychological traps, you should mention the name of the trap that this person is falling under. So the names are quite important, okay? And then of course, when we talk about data, historical estimates, so these are all the things that you can talk about. right? So that's just a quick example of how a case could be tested, right? And as you saw already in your TMA, usually cases are quite long, and this is not the only issue being that should be addressed, right? You have all the other issues that we mentioned previously. All right. Okay. So now, so that's just about psychological traps. Now we're talking about what about statistic tools to use to form market expectations, and there are a bit of calculations. So first of all, we can use sampling, right? So looking at the past, how does the past data sample might predict the future? So this is very common, right? So I think previously we did about like asset allocation, we talk about diversification. So all these diversification, you calculate the risks. Remember, we calculate standard deviation, we calculate returns. So all these are past data, right? So we're basically taking a sample, right? A small sample of, let's say, 5 years or 10 years, right? And then you try to predict. So this is called a sample estimate, all right? I see a question. So are these the only traps that? Oh, so basically, I think the last lecture, there's this picture, right? Like a picture of a lot of biases. So basically, the more you know, the better, right? Because at the end of the day, the exam questions will not be state all the biases, or state 5 biases. It won't be like this. It's more like a case. So like even today, we will give you, or I'll give you a lot of tools. You need not use every tool in the lecture slides or in last 2 lecture slides, but it's more to make you or allow you to think about the issues. And so if you identify, okay, maybe it's this psychological bias, or maybe I should use these tools, that's where you implement the tools, right? Because at the end of the day, the questions are more case-based. So you need to basically have the tools first so they can answer the questions, right? So I hope I can answer that. So for example, if you feel that there could be, sunk cost bias, you can even mention it. It will not be wrong answer, right? Even though it's not covered in the syllabus. All right. Okay. So moving on to the next statistical method, there's this shrinkage estimate. So basically, we are using kind of like a weighted average of historical estimates. Therefore, because we're using a weighted average, you reduce the extreme values, right? Very small, very large values. So that's more like shrinkage estimator. Okay, then we have the time series. If any of you are doing statistics or have done statistics before, and we can have talk about this thing called regression. So regression analysis use quite a bit of this idea of time series estimator, where you actually do a lag variable, right? So basically, how it works is that, first of all, you're forecasting. Okay, so before we look at all these detail here, let's just think about it. So if we are forecasting the stock price for next year, how do we have the basis to forecast the stock price next year? We need the stock price now. So the stock price now becomes a lag variable, right? So stock price now plus something becomes stock price later. So immediately, can you see that the stock price in the future, we can call it T, right? T. And stock price now is T minus 1, right? Stock price T minus 1. So basically, it's a lag variable. So that's the kind of understanding or intuition of how a time series estimator works. So you basically need a basis for today to forecast the future. And so in this example, we mentioned about this kind of this formula, right? We are calculating more of the volatility now, so not the returns, more the volatility. And anyone can recall, volatility is measured in standard deviation or variance. Which one is the right one? SD, yeah? Okay, perfect, yeah. Okay, then everyone's on the right track. So yes, SD. So yes, this mention is square, but then if you want to find out actual risk or total risk or volatility, it should be square root. So in this case, we work with the square, of course, then later we square root it. And they give you that, so the volatility so-called next year on the future at T is equals to a volatility T minus 1 here, right? Plus some error term. So if you do regression, you know that you always have an error term here. All right, and basically, what is this beta? This beta is it can be actually anything, but in this specific formula, because it's a closed form, closed form meaning that there is no, it doesn't keep on continuing, right? So it's closed. This beta means the rate of decay of the volatility, which is given here. All right. So if the beta is higher, there's more volatility during one period, right? So for example, if this beta is high, then you know that for next period, your overall volatility will be higher. All right. So for those that might be a bit rusty on like your regression, so the error term here actually is you don't really bother too much about error term because the error term will always be there. So what we are actually focusing on is just this portion here. All right. So we have also the multi-factor model. Basically, we are trying to explain more of the asset return, but from various drivers of the return, or even various assets. So what is actually driving the total returns that you are receiving, right? And remember, when we calculate total returns, we need to consider risk as well. And when we consider risk, we need to think about the correlation. So sometimes we do the correlation metrics. It's not new, so we do a correlation metrics and therefore find out what correlation is, and then we calculate what's the risk, and then therefore we also can calculate expected returns for the portfolio. So this multi-factor, so various factors, right? Now, I hope the first one shouldn't be too new to you. So the first Gordon growth model is basically your perpetuity formula, right? This is in your year one, so everyone's okay. Okay, have anyone not seen this perpetuity formula, or everyone's have seen it before, or vaguely remember? Everyone seen it? Never. Vaguely. Okay, those that maybe never, if you are year one, okay, maybe you haven't taken the financial management course, but yeah, okay, so vaguely. Okay, so the Gordon growth formula basically helps you price a stock. So if you can't forget, this is just a very short recap, but if not, you should go back to your year one notes. Okay, so the Gordon growth formula basically help you price the stock, and when pricing a stock, we need to use the idea of a perpetuity. So a stock will keep on growing forever, or sorry, a growing perpetuity. So the stock keep on growing forever. And by pricing the stock, we kind of can form the market expectation, right? Do we think that the stock will keep on growing, or is it going to be a negative growth, right? So RE, which is the expected return on the stock, right, is given by D1 divided by P naught. So D1 is the dividend next year. So this is very important. And highlight again, is dividend next year. So if you are given D0, which is the dividend now, you need to take the dividend now, all right, multiply by 1 plus G. G is the growth, right? The growth of the dividend. So how fast the dividend grow. So you need to do 1 plus G. So let me just quickly write it here. So okay. So D1 equals to D naught multiplied by G, right? Or actually, let me just. Right, so D1 equals to D naught multiplied 1 plus G. So let's say if in a question they give you, oh, the dividend paid now. So the now is very important. So when you see the word now, means that it's D naught. So that means the dividend now. So the formula requires you to put D1 divided by P naught. So D1 is the dividend 1 year later. So that's how you get D1, okay? And then you divide by the current price, all right? Then after you must plus the growth factor, which is G. So G is usually something that's been estimated, and they use various. So this is not the only way to estimate G. Most of the time, it will be given to you in the question what G is. But if you do need to kind of formulate G yourself, as a portfolio manager, then you can think about issues like, what's the GDP growth, are there any premium, or they call it excess, that's being placed because you are holding an equity, right? So again, I want to mention that if this what D1 equals to D0 plus 1 plus G is a bit unfamiliar, try to go back to your year 1 notes, because I think they go very detailed in this and even give you some examples on how to calculate it, right? Okay. I'm not too used to this using this. Okay, so the Gordon Grove formula is not new, but what is probably new is this other formula, Greenot-Kohner formula, right? And I think this is probably something new to everybody. And this formula, again, at the same time, tries to formulate how do you calculate the expected return on an equity. All right. So in this formula, what is given is actually very similar to the Gordon Grove. If you can see, it's actually D1 divided by P0 plus G. But now we want to consider more things, right? We want to consider, okay, are there any changes in outstanding stocks, right? There's any change in S. At the same time, we want to think about the inflation, right? The last time we also talked about a bit of the Fisher equation. So yes, we need to consider inflation here. But in this case, they are considered inflation not via the Fisher equation, but just add inflation I. All right, and then they want to consider also the change in PE ratio. Basically, what is the change in the price earning ratio of the stock? So there is an example for this because this is a new concept. So we have this information here, right, for the various, the market, the current, the 10-year historical, the current, and the capital market expectation. So we have all this information. All right, so now we want to calculate what is this Australian equity risk premium, right? So what we're interested in is equity risk premium using this Greenot-Kohner model. All right, and then the important thing is there's no change in number of outstanding shares. So what does this mean? It means your change in S is 0, right? So there's no change in S. Okay, so change in S is 0, which is good. It's given here. All right, and then we know PE. So how do you get the PE? Let me just jump back to the previous slide. So we know that the current PE is this, right? And expected PE is this. So we know the change in PE. Basically, we just take the difference and divide by it, right? So we get this. And then from there, we can plug in all the required information for this formula. So we have the change in S is 0. We have no change in P in this. I believe the inflation, let me see, what's the inflation? We have 3.3 for inflation. We have the 10-year bond at 5.6, right? So so these are, sorry, no, it's 1.5. Sorry, they use the market expectation one. So this is the annual income here, and then the expected inflation is here. Because they are basically, because you don't calculate expected return, so we use the expected values instead. All right, and then so what is the equity risk premium? So the premium basically is what is above the current level. So what is the additional premium because you're holding equity? So we take 6.6 divided by 5 minus 5.6. So 5.6 is this, the bond yield. So the bond yield is your long-term kind of bond, right? And you know, government bonds, we mentioned previously, government bonds are so-called risk-free, right? So any return is above the risk-free is basically the premium. And in this case, for equity, there is a premium on top of that, right? That's how we calculate equity risk premium here. Okay. Any questions for this? Good. All right. So again, this it goes back to your year one again. It's on bond pricing. So for bond pricing, we are using the annuity formula. Yeah, it shouldn't be new to everybody because this is year one. But what happens in bonds, right? I'll just explain very generally. If you need, remember, refer back to your year one's notes. What happens generally is that for bonds, we know we get coupons, right? So your coupons are your CPN. And your coupons are almost like annuity, basically payments, periodic payments until a certain date. So in this case, until your bond has matured. But what's interesting is that for your bond, we know that at the end of the day, we get back the par value, right? So I hope you remember your time value of money. If you know that you're getting back your par value, your FV must be a certain amount, right? Because you're getting back FV at the end of the day. So do try to do a bit of recap on how you use your time value of money, whether it's on Excel or financial calculator. Okay, so in this sense, usually you don't ever have to use this formula. You just plug in the numbers in your financial calculator, you get the answer, or in Excel you get the answer, that's fine, right? So what's important to take note is that for coupons, in the market, most of the time is semi-annual, right? Questions they will specify whether the coupons are getting annual or semi-annual. And remember, when we are doing semi-annual, we need to multiply the N by 2, right? So if it's a 10-year bond, if it's a semi-annual, N becomes 10 times 2, right? And then, yeah, your yield to maturity basically is what is your discount rate, R, that's given here. Okay, yeah, I won't go into too much detail because this was actually covered previously. About what's important, because now we're taking a broader perspective in the sense of more asset location, more as a portfolio manager. What's interesting is that, okay, the yield to maturity is an important number to calculate. Why? Because when we have the yield to maturity, we can actually estimate what's the equity risk premium, like what we did just now, right? And how do we get the yield to maturity? We basically calculate your I/Y, right, in your formula. Basically, if you have your present value, you have your future value, you have your coupon rate, you have the years to maturity, you can get the yield to maturity, right? You just plug in all the numbers in your formula and you get yield to maturity, right? So the yield to maturity is quite important. And because in this formula, so again, if you go back to year one, your professor will tell you that if you're going to use this annuity formula, one of the issues of annuity formula is that you're assuming that your coupons are being compounded, because we always talk about compounding, right? We're never talking about simple interest at all when you talk about time value of money. It's always about compounding, right? So your interests are being compounded at the rate of the yield to maturity, which is a problem. Because why? Because if your yield to maturity is 10%, the thing is, do you really expect the market to give you 10% on your coupons? Maybe no, maybe because the interest now is only 5%, right? So issue with this is that you are expecting the yield to coupons to be compounded at the yield to maturity, which is an issue, which is why most of the time we use zero coupon bonds, right, to estimate yield to maturity here. So basically zero coupon bonds has no coupon, and therefore you circumvent the issue of the compounding of your coupons at the yield to maturity rate. All right. Okay, so that's a bit on two different formulas. Now we go to the third approach. Remember again, right? Keep reminding yourself, all these are tools basically to help you form market expectations. So the third approach is more of the risk premium approach, which is actually what we kind of covered in that question, where we say, the expected equity return is the long-term bond yield to maturity plus the equity risk premium, because just now we are calculating equity risk premium, right? So basically we're just shifting the formulas a bit. Okay, and when we talk about long-term, it's generally 10 to 20 years. All right, so basically we know that equity is more risky than bonds, right? So if you are going to buy equity, you should be rewarded by some premium by holding more risk. and therefore that is the equity risk premium that is above the bond. All right, so this is just a quick look at the various equity risk premium. Nothing to, can just look at it when you're free. Now there's this other question where they want you to calculate. So it's basically the same sets of data, but they want you to use this bond yield plus risk premium method. All right. So when we do a bond yield plus risk premium method, we should focus on more the historical portion here. All right. So the answers are right at the back. So how do we focus here is that, first of all, we know the bond yield is 6.6, right? So we know that, sorry, so the equity is here and the bond is here. So we take the equity, which is more, minus the bond, the lower amount, the bond, the 10 years bond yield amount, and that's the difference gives us the risk premium, right, on the equity. So 7.3 minus 6.6, this is what we get. So this is more of the various estimating methods. So if you notice, right, the answers of estimating the equity risk premiums are different. Generally, what happens is that in the industry, we will use various methods, and maybe we take a weighted average, or we take a simple average of the final calculations, which is why there are various methods of calculating. All right. Okay, so now there's another way to calculate fixed income returns or yield to maturity on bonds. Fixed incomes are bonds. So just now we talked about the annuity formula, right? So now this one is more of just thinking about bonds having various risks, and because these bonds have various risks, we should be rewarded by this risk, and the rewards comes in the form of a premium, right? So on top, okay, so the risk-free rate is, the basically risk-free is like there's no risk, right? But at the end of the day, when you take a bond, there's issue of inflation that will impact your bond. Out of curiosity, everyone knows when inflation go up, does the bond price go up or down? So inflation go up, so inflation go up. Okay, someone say that the bond price will go up. Okay. Okay, so maybe actually it is down. Okay, so I hope you remember that bond price and interest rates are inverse, right? Bond price and interest rate are inversely related. All right. So the thing about inflation is that when inflation goes up, interest rate usually goes up as well, right? And because interest rate go up, your bond price would go down. All right. So remember that. So the key concept I want to highlight here is that bond price and interest rates are inversely related. So I think this probably again was covered long time back in year one, but yeah. So when interest rate go down, bond price go up. When interest rate go up, bond price go down. Okay. All right. So that's on the inflation premium. And then we have the default risk premium as well. So default risk premium is more of like, if the bond issuer default, you should be, your bond will be useless, right? So you have a premium on top of that. Your illiquidity premium, basically it's if the issuer cannot pay you, right? Goes into issue of bankruptcy, cannot pay you, so that's illiquidity. At the same time, also when you hold a bond, right? Are you able to trade it openly in the market? Most of the time, no, because bonds are usually traded off the counter. They call it OTC, right? So they're not traded on the exchange. So because of that, it's more illiquid compared to a equity. And there's interest risk premium. Just now we talk about when interest rate changes, the bond price will increase, decrease, whatever. right? And then there's tax premium and maturity premium. So tax is, whether the bonds will be taxed, the coupons are taxed, whether par value will be taxed at the end of the day, and of course, maturity premium. Basically, the longer you hold a bond, higher the risk of default, and therefore higher the maturity premium. Right. Okay. And then another way to form your market expectation is the Black-Litterman approach. This one we covered it last lecture, so I'll not talk about it. Basically, is to reverse engineer what returns you want. Right. Okay, so I hope again this is again your year one thing. So you will notice a lot of these calculations, right, are actually year one topics. So this is the CAPM model. It's like the most famous model, right, to calculate your expected equity returns. Remember, it's only equity, only your expected equity returns. We can use the CAPM model where RF, right? So expected returns of equity equals to the risk-free rate plus this one is basically your equity risk premium, or your risk premium here, right? So it's your market returns minus your RF times your beta. All right, so this was covered in the last lecture. So can I check what is the market beta? What is the number of market beta? Anyone? 1, perfect. And for risk-free asset, what's the beta? 0. Okay, very good. So you all know about the 0 and 1, right? So those two are the one of the most important information. So basically what we're trying to say, if your asset move with the market, it should be as close to 1 as possible, right? And if your asset that you have has very low risk, it should be as closer to 0, right? So a small beta has lower risk, all right? And then we also talk about this CAPM model back last lecture on where is it on the line, right? We talk about the security or security market line, right? SML or security capital market line, CML. CML as SML, both can be used. So that is the line that touches the frontier, right? That when we include the risk-free asset. So the same thing, right? We are using the CAPM model actually is the equation of that line, the security market line or capital market line, right? Now, so these two are the same formulas. Basically, risk premium can be said to be this, right? If I won't go through, but now for beta, so just now why I asked the question about 0 and 1 is that beta measures the risk compared to market. So in that sense, right, we have this formula here. The beta of an asset equals to the covariance of the asset with the market, right? Because everything is compared to a market beta of 1. So what is the covariance to the market divided by the variance on the market? So this will give you the beta, right? So this is an important formula in case any questions comes out and say, oh, we have a covariance of the asset has a covariance of the market to the market of XXX amount, and we have the variance of the market as this. So we need to be able to know how to calculate the beta, right, of the asset. So we have another approach. This is called a Single Tengah approach, where we basically we take the CAPM model and then we transform it and include more details, right? And what details we want to include? We want to include whether the market is an integrated market or is a segmented market. So this is going to tap a bit on your economic knowledge, right? So what is an integrated market? What is a segmented market? So simply put, right, is that if the market is fully integrated, means that capital goods or even people, human capital can move from one country to another, right? There is no border that actually blocks off the movement of capital. And because of that, right, because of this very easy movement, then we need to consider what is actually the correlation between the assets and the market, right? So let's say we are talking about buying an asset in the US and you are in Singapore, right? And because you are buying from a different country, we need to consider now the correlation, right, between, let's say, US to Singapore, which is why in a perfectly integrated market, your risk premium should include this portion of correlation here. Okay, and if you do remember, this portion is your Sharpe ratio of your market portfolio. So this is important because sometimes, right, in questions, they will just tell you, oh, the Sharpe ratio is this. Let's say the Sharpe ratio is 5.6. So we need to know that what it means is that this portion of the equation here is 5.6, right? And this is the Sharpe ratio. So this is a perfectly integrated market, right? Things can move very easily, and because things can move easily, we need to consider correlation. Now, in a very segmented market, right, what happens is that whatever that's local remains local. So for example, you can only buy Singapore stocks, and that's all. And if you are in Singapore and you're buying Singapore stocks, then your correlation is 1, because that's the only, there's no different correlation, right, between different markets now. And so when a market is completely segmented, that's where you omit the correlation component. All right, so there's nothing here. All right, so these are two extremes: perfectly integrated or completely segmented. We'll have one question here. Okay, before the question, okay, we have a bit more information. Basically, this is something you can read about. We just explain to you that in this approach, we might also include a bit of the illiquidity premium, which we'll see in the next question, that how they actually include it into your CAPM. So basically, you calculate CAPM ready, then you just add the percentage, the illiquidity premium percentage. All right. So this is an example here. Like I mentioned, sometimes they tell you the Sharpe ratio. So they say the Sharpe ratio of GYM, which is basically like a stock, right, is 0.28. There's a risk-free rate of 3%, all right? So for US real estate, he estimates that the standard deviation is this. Okay, so you're giving standard deviation. The correlation of GYM is 0.5 and illiquidity premium is 0.3. All right, so assuming that the US real estate is 70% integrated, so now we know that it's not completely integrated, and we know that it's not completely segmented, right? So it's 70% with GYM, which is the other market, right? Where the stock is. Estimate the expected return on the US real estate. Okay, so how do we tackle this? So we know that there are two extremes, right? Whether you're completely or you are completely integrated or completely segmented. So let's calculate that those two extremes, and then we know that because it's 70%, we just take 70% of one component and 30% of the other one, and we get the rough estimate. All right, so that's the strategy. So once we have the strategy, we first of all calculate what's the perfectly integrated. Remember, when it's perfectly integrated, we need to consider the correlation of 0.5, all right, here. And then we have the standard deviation as usual. And remember, because the question will give you Sharpe ratio, I told you that something divided by something is a Sharpe ratio, right? So we just plug in your Sharpe ratio here. And for this approach, we can just add the illiquidity premium, which is given here. Okay, and then we get the perfectly integrated. Now, to get a completely segmented, basically it's the same thing, but what do? We omit the correlation. So there's no correlation here. There's no 0.5 correlation, and we get this answer here. All right. And what happens is that now we know that it's 70% integrated, right? So we take 70% of the perfectly integrated component and 30% of the completely segmented. So basically, we just take out like almost like a weighted average, or actually not almost, it is a weighted average. So weighted average of each of the risk component. All right. And then once we get this answer, we can find what is the expected return on the real estate, because we know that the risk-free is 3%, right? So remember your premium, because remember all these you are calculating the risk premium. So anything, if you want to calculate what's the expected return, is the risk-free plus your risk premium. So we just add the 3%. Just add 3%. Maybe I'll just pause here for a while. Any questions, any issues with this calculation? Very good. Okay, maybe because before we move on to inflation, let's take a quick maybe 7 minutes break. We'll be back at 7 minutes, or yeah, 8:02 p.m. on your time. Okay. Yeah, let's take a quick break. All right, welcome back. I hope you have a quick short break. Go to the toilet, get some tea or coffee. All right, so let's continue on inflation. So, like I mentioned, it's a bit of an economic kind of concept. So, inflation, simply put, right? Let's talk about the broad concept. I think everyone obviously heard about what inflation is, right? Now, inflation is caused by two things: demand and cost pull. So if you just think it simply, right, is there's too much cash chasing too little goods. So that's caused inflation. All right. And then of course there's demand and cost. So demand is where the demand for goods is too high. Therefore there's not enough supply. And then cost is where there is shortage of supply. And this shortage of supply causes the goods price to increase. All right. So that's like the broad idea of inflation. Now, to bring it into context, right, in the current situation now, which I think is quite applicable to all of us, right? And to bring in the idea of interest rate, because sometimes when we think about interest rate inflation, and things get a bit convoluted, very confusing, like, right? So, and anyone can remember, why is the interest rate increasing when the inflation is increasing? Anyone have an idea of why? Or yeah, what's the reason? But is it like, oh, because interest rate is also inflation, or are they separate things? Like, cost more to borrow. Okay, that kind of is the reason cost more to borrow, but why would the interest rate increase when inflation is increasing? Actually, what's happening here? Anyone knows the mechanism? Okay, so why I'm trying to ask you this is because let's say if you're a portfolio manager, or maybe you're not a portfolio manager, or maybe you just want to manage your own funds, right? To be able to understand all this kind of gives you the indication of what's happening in the market. Control money flow. Very good. Okay. So I think we're getting increase the loan to reduce the number of loan. Yeah, perfect. Okay. So we can see that it's a bit of monetary policy. Okay. So most of y'all have this knowledge. That's very good. So for benefit of all, right, let me explain also. So basically when you increase the interest rate for let's say your mortgage or what, or generally all interest rate increase, right? What is happening is that hopefully what the government is hoping for is that for less money to be in the market, because now you are more painful, right? Because you need to pay your high mortgage, let's say you buy a house, right? And when there's less money now to buy goods and services, your inflation supposed to slowly reduce, because when there's lesser money chasing the goods, your cost of goods would decrease. All right, very good. So, but the problem is that why are we still experiencing inflation now when the interest rate has increased by so much, right? The issue is that inflation is a very sticky concept. I'm sure some of you have heard of this thing called sticky pricing. So sticky pricing means that it takes a while for the inflation to actually catch up with the not really catch up as in like to reduce with the increasing interest rate, right? Yes. So due to recovery of COVID as well, right? So now you mentioned COVID. Okay, so this short discussion is not really in your syllabus, but it's something that it's good to know and also could help you understand inflation and interest rate more. So very good. I think you mentioned the recovery of COVID, but what's happening in COVID? So remember during COVID, a lot of us got some stimulus packages, meaning like we got some payout by the government, right? And when there's a payout by the government, what happened was that our wealth actually increased. And when our wealth increased, means that there's more money now, right? Chasing goods. And that's why inflation increased over time. Now, what the government is doing now is to increase the interest rate to reduce the number of cash in the market. So now it's a reverse. So because COVID has recovered, right? So now the government is trying to reverse the process of the increased stimulus in the market by increasing the interest rate so that there's less cash chasing the goods and hopefully to reduce inflation. All right. Okay, I see a comment. So, yeah, perfect. Yeah, you're right. The explanation is perfect. Yeah. So you can actually mention in case there's a case, you can mention this concept of inflation and interest rate as well. And so the idea of sticky pricing is that like a lot of things, right? If you realize the prices are not decreasing so rapidly now. In fact, a lot of let's say if you go to hawker center, right? A lot of hawker center are still maintaining their prices. But actually, it shouldn't be the case because government has increased interest rate and the prices should start dropping. But we don't see the drop because what happened is that government are now, not government, but businesses are now capitalizing on the additional income, even though the ingredients and stuff prices might have already slowly decreased, right? So there's a portion of sticky pricing here, as well as if any of you are renting apartments, maybe not so much in Singapore, but if you're in the rental market, you know that the prices in the rental market are at the highest it has been in Singapore for the last 10 years, right? And so knowing about this idea of sticky pricing and knowing the idea that government has increased interest rate, actually, what's your expectation? Okay, does anyone know? So what is the rental market expectation in the future? So I repeat again, right? So knowing that the government has increased interest rate, and that is to tackle inflation, and you know that prices are very sticky. So what can you formulate about your expectation of, let's say, the rental real estate market in Singapore? Mm, okay, yeah, I think I saw the right answer. I think Aaron mentioned. So it will take a while for the rental market price to go down. That's the perfect answer. Yeah. So can you immediately see how knowing inflation, knowing interest rate, knowing all these kind of market forces can form your market expectation? And as a portfolio manager, right, with this market expectation, you can actually suggest or convince your client to do certain things, right? So that's the right answer. So yes, the rental prices will come down, but it will come down slowly. So if your client is looking at, let's say he has a property, he wants to rent it out as investments, what should you recommend? You should recommend that he immediately rent it out as soon as possible now, knowing and lock in a long-term rental contract with the tenant, right? So that he can lock in high value, because you know that rental prices will go down slowly because of the various monetary policies that has been put in place by the government. All right. So yeah, that's the basically the idea of this whole discussion or this whole lecture today, right? It's basically how you form market expectation and how do you help your client implement certain initiative to maximize his returns and reduce his risk. All right. Okay, so knowing having that small discussion, we know that certain assets are good to hedge inflation. We kind of mentioned it already. Cash would the value of cash increases with inflation because your interest rate increase, right? Generally, when your interest rate increase, where inflation increase, your interest rate increase as well, right? So it's good. But remember, we talk about interest rate and bonds, because when inflation increase, interest rate increase, bonds the value is inversely rated, so it decreases, right? So it erodes the bond value. Stock generally perform well when inflation is moderate, right? Not when there's high inflation or high deflation. Real estate, as I mentioned, is a good hedge for inflation. I think we mentioned this a few times, and we talked about REITs as well. All right. So we can actually do an economic analysis of the market and to see whether there is any lead-lag relationship. And just now we mentioned about this idea of sticky pricing is a lag relationship. So we know that by understanding the rental market, we know that, oh, you know what, we should quickly rent out your apartment now because we know that rental prices will drop as the year or as the month progress, right? So to understand the various economic cycles would be quite important. All right, so again, there is this measure of economic activities. We measure with GDP, whereas the actual GDP minus expected GDP, right? Then that will give you the output gap in the market. Okay, so I won't really go through this. You can just read about it. What's GDP? You know, basically a recession is 2 successive quarter of decline, right? There's a recession. So you can just have a look at this. So when we talk about business cycle, we did mention a little last lecture. So, and I think I mentioned like a general business cycle is 9 to 11 years, and there's ups and downs in business cycle, right? Peaks and trough. So to know where the business cycle is will be quite important. So we talk about how the current business cycle is more towards a recession or maybe a technical recession, or there's a bit of a upwards now, you know, with COVID becoming the past. But at the same time, there are more external pressures, right? There are a lot of political pressures that is forcing or preventing further upwards growth, right? Like we mentioned about, or you can see the market, like, you know, the Ukraine crisis, the oil issue, right? And then of course the opening of China is also a very big issue now on the market, right? Because when since China opened up, a lot of investments are re-entering China, and when the investments are entering China, there's high demand for raw materials, you know, in China, right? Or even oil. And therefore, there is a lot of pressure on the market to support the growth in China. And because of that, certain resources, when there's high demand, you know, your prices will increase as well. And this has even further caused inflation to not decrease so fast, even though interest rates are so high, right? So inflation is still increasing or even maintaining, right? So the opening of China has quite a big impact on the market. All right. So, you know, back to the business cycle, there are 5 key phases that we look at. And we can see here, so there's an initial recovery, early upswing, late upswing. So initial recovery, maybe some optimistic people might say we are in the initial recovery now, right? There's increasing more confidence, people are getting better. But at the same time, because of like some measures, some geopolitical factors, maybe the recovery would be delayed, right? So we need to see. One issue about this initial recovery, right? They say, yes, inflation is falling. Besides the idea of sticky pricing, right? If you notice, if any of you are in the market now for a job, you notice that the job market is quite hot. A lot of people are jumping around. Maybe less hot compared to last year, but it's still very hot, right? And people are still getting a lot of increases in terms of their discretionary income. And because of that, right, individuals still have the wealth to purchase goods and services, even though the government has increased interest rates so much. And because of that, it has a moderating effect on inflation, right? So it has caused inflation to continue to be high and not fall because of this moderating effect of jobs. So it's a very unique situation now, because when we are in a financial crisis, usually things are like unemployment is very high, and issues like the issue of unemployment is a big component of recession. But now we are like the past 1 year is like a recession, but at the same time employment is so high, so it's a very mixed signal thing. So because of this current situation, maybe it might be hard to place which business cycle you are at. So in case there's a case that comes out, you have to try to provide justifications, right? What business cycle are we at? Or maybe we are not even at any of the 5 business cycles. That's possible as well. Of course, the main thing is you have to provide justification of why you think it's not there, right? So, like I mentioned, we could be in initial recovery, but maybe not, right? Because inflation is still not falling yet. All right. Bond price peak, fine, stock price rise strongly in the initial recovery. So in case your market expectation is, let's say you believe that we are in the initial recovery, then you should recommend your client to quickly purchase stocks, right? Because you know that stocks will increase sharply in the future, right? So knowing which cycle you're at allows you to preempt certain investments. So in an early upswing, so if you miss the initial recovery, then you go to the early upswing, like in the sense that, oh, the stock price already trended upwards, and you should quickly sell your bonds because your bonds are quite stable, but you know that after early upswing, your bond price will drop. So you must quickly sell away your bonds, right? Before the prices fall. Inflation remain low, interest rate remain low as central bank starts to withdraw the monetary stimulus. So remember just now we talked about COVID stimulus. So it almost seems like we're early upswing, but maybe no. So it's how you justify, right? Because you know, central bank are, first we already stopped the COVID stimulus, but now with the high interest rate, the bank is actually taking back the stimulus, right? In a very indirect way. Late business upswing, and then basically everything's going up, right? It's good. So bond price fall, the stock price is the highest, the best. So yeah. I see a comment that, hospitality is hot from, yeah. So I guess knowing the industry also helps, right? So you say, yeah, hospitality is one of the there's a hot recovery, right? I think if any of y'all have friends in the aviation industry as air attendants, or you know that now like SQ and everything's like hiring, right? Going back to, yes, SQ is like hiring like crazy, right? Because they had to lay off so many. And in fact, if any of you are planning to travel, you know that the air tickets are like, even this year is better. Like now, the start of the year, prices has moderated a bit, but it's still quite high, right? Compared to pre-pandemic. So yeah, some of y'all, if you are planning to travel, you know that, oh wow, it's actually very high now. So there's a sharp recovery, but at the same time, remember the high prices are not because only of demand, right? So think of market factors because of the oil prices, and if I believe some of you have done hedging, so you know that companies or airline companies do oil price hedging, right? So basically, what happens is that they most likely, because I think now what I recall last week, I saw oil prices falling, or they are more stable. But if the company has hedged last year, yes, if they buy oil futures last year, oil futures would probably be very high. So they might be actually buying at a very high price, and they might record some unrealized losses unless they can unwind their futures. So those are some considerations as well, and things to think about, right? When you think about business cycle. All right, so then we have the slowdown. Inflation continue to rise. So some people might say now is a slowdown, right? So it's not an initial recovery yet, it's still a slowdown. So it really depends on how you justify. And it might be a recession. The recession is very bad when there's 2 successive quarters of decline. Yeah. Or you might actually say it's still a recession now, right? So you believe that stock price will still continue to fall and bond price will still continue to increase. So it depends on how you see it, right? So once you form your market expectation, that's where you can advise your client. Of course, you need to explain your rationale of why do you expect certain trends in the market, right? So that's why we are trying to study this. All right. So there are factors affecting the business cycle. I think we talk a bit about the industry. So businesses can affect in the business cycle. Largely your consumers, right? What is their spending? Are they spending more on discretionary items, or are they spending more on non-discretionary items, right? And of course, your foreign trade as well. So whether you have more trade or less trade is like I mentioned, right? When China, or now that China is opening up, foreign trade would drastically increase in China. While this might be an engine to stimulate the economy, it will actually have certain impact on prices of commodities that is being consumed by China. So there is both a moderating fact. China will help to stimulate the overall economy, but at the same time, they will have more demand. And when there's higher demand, and given the issue of or the high oil prices due to the Ukraine crisis, this could actually push oil price up again. And we know that when oil prices go up, right, this could push the entire economy to a recession. So now we need to consider whether the stimulating effect of China and the oil prices, do they cancel out, or which one has more weight, right? So this will help you form a market expectation. Okay, so we did, I think we haven't covered fiscal policy. So fiscal policy, basically it's, actually we did, when we talk about inflation, about whether to cut spending or to raise the taxes. So like I mentioned, when, let's say, to increase spending, right? Increase spending means like, oh, the government, let's say, build, the most common is to build infrastructure project. That's where the government is increasing spending on the market, right? So usually fiscal policy, it's used to stimulate the market during, let's say, a recession, right? So you increase spending, hopefully to generate more productivity in the market. So they could actually use some called unemployment benefits, or when we talk about COVID, it's more like COVID stimulus, right? So those will help to stimulate the market as well. So actually, an interesting thing, right, is that if your expectation that inflation is falling, what should you do about your non-discretionary purchases? Does anyone know? Okay, so let me explain. So this is again, it's about market expectation, but it's very useful for portfolio management. So what happens is that if you know inflation is falling, you should defer your non-discretionary purchases, right? Non-discretionary purchases mean that things that you do not need. For example, if you're on the market to, let's say, buy a house, right? But you already have a house, right? Let's say you have a client, he has a house already, he wants to buy a second house. Now, you know that inflation is falling. Perhaps you should defer your purchase of the house, because you could actually purchase the house for a lower cost in the future, right? Now, on the reverse, if you know that inflation is increasing, then you should quickly buy the house now, right? Before the house price increases even further, right? So basically, the inflation can actually impact whether you recommend a purchase of non-discretionary items for your client, right? We don't talk about discretionary items. So discretionary items include like food, all these things are like necessary, right? So regardless of inflation, you do have to buy it. All right, so monetary policy, we talk about the supply of money in the market. So you know that higher the supply of money in the market means that you will push prices of goods up, right, due to inflation. So it is quite a bit of a balancing act on how fast you increase interest rates to in order to affect the amount of money supply in the market, right? So most of us here have a job, right? Or if you're full-time, you will probably get a decent job. So the issue with raising interest rates in terms of like a monetary policy is that the most affected are the ones that are jobless, right? So if you have a job, most likely your job would increase your compensation at the inflation rate, right? And you're not too affected by it. Yes, you might feel a pinch. Maybe you will skip one or two. Yeah, okay. So if you have no pay rise, so maybe you will avoid going to your fancy restaurant. Go less, eat out less, right? You cook more, maybe, right? Yeah. Okay. So but most of y'all that have a job or will have a job would not be impacted by inflation. The most vulnerable are those that are jobless, where inflation becomes a real burden because they cannot afford your non-discretionary items. That's not mix up the words. And yes, there is usually a lag in the market because of the issue of sticky pricing that the market will have to chase increase or chase the inflation that's happening. All right, so you can read about these monetary policies, not too much. So what I'm trying to say at the end is that government can use both fiscal policy or monetary policy to impact the economy. And because government have this power, it's important to observe and study what's happening in the market. Yeah, so going back on the pay rise, so you know that there is a bit of a lag. Hopefully, in the next year or even this year, you might get the rise because there's a lag in the increase in compensation. All right. Okay. So in terms of the central bank behavior, we have this thing called the Taylor rule. So the Taylor rule should try to explain, okay, what is the short-term, the best or the targeted short-term interest rate given the economy at the point of time and given the forecast inflation. All right. So again, it's quite intuitive because we just take the current, all right, the targeted the current short-term interest rate here, all right, then you plus, okay, the question is why 0.5 and all those things. So these are done using modeling and regression and stuff. That's why they found, oh, actually 0.5 is like the perfect number, right? Why not 0.3, 0.4? Yeah, so it's done by modeling. So basically, if you accept that 0.5, then you just simply take what's forecast and what is the trend, right, of the GDP, and then you take what's the forecast and the target of inflation. And by taking this idea of GDP and inflation, we can calculate what is the short-term interest rate target for us that is set by the central bank. So, this is just explaining more about how rates will increase certain things. So lower interest rate would encourage more borrowing by the consumers, higher stock prices, stimulate the market, stimulate money supply, right? Because low interest rates means more spending, so more stimulation in the market. Okay, so this is a very quick example of just how you're going to use the Taylor rule. I think it's not too complicated. Basically, you just plug in the figures, right? You have your short-term interest, and then you know what is your target and forecast, right? So you just less it off, and then you should get the targeted optimal short-term amount. Any comments, any questions so far? We are good. Okay. Okay. So about economic growth trend, generally they refer more to the long-term, GDP kind of indicators of what's the trend of the GDP, right? Generally, growth trend is more or less quite stable. And the growth trend is basically your G. Just now we mentioned about the Gordon growth model. Remember, there's this idea of G. And if you recall, I think maybe in year 2, you might have taken certain course that requires you to do the discounted cash flow method. And we know that in order to calculate terminal cash flow, hope you remember what's terminal cash flow, your cash flow from year X until infinity, right? When we calculate terminal cash flow, we need to use the idea of growth G. So the growth trend basically is how you estimate this G number or percentage or whatever you want to call it, right? So this is basically a growth trend. So it's important for your Gordon growth model, but not only that, your discounted cash flow as well. And there are various components in terms of growth trend, and then we go back to economics as again. We have your labor input, and later we talk about production. So labor input is what's your labor force size, what's your labor participation, how what's your population or labor population like. So very interestingly, right? I'm not sure if any of you are foreigners here. I don't think so. I think most of you are locals. So if this might not be something that you realize, or if you're in HR, you might realize it, that actually Singapore has a very open labor policy, meaning that we actually welcome a lot of foreigners, and in a sense that we make it so very, very easy for them to relocate here in Singapore, especially if you compare it to, let's say, because now in Canada, Canada is like a world of a difference, or the US, right? The US is a world of difference. If any of you are in the process of getting like a green card, you know that the process is very complicated. Yeah. Perfect. Singapore is very open to labor immigration, which is a good thing for skilled labor. And generally, research has shown that open market policy open labor market policy generally benefits the country, right? So it drives business, drives cash, it drives investments, right? Investments in the country. So we mentioned about foreign trade, foreign investments, so it drives that. So but the thing is, not that even when I was like studying at a point of time, I did not realize how open Singapore policy is until when you are, let's say, in your job market, or maybe if you are abroad, then you notice that actually, wow, Singapore is very open. It drives business and cash. And because of the openness in Singapore, it actually increased our labor productivity. And it's very productive, right? It's very high. And so labor productivity is also one of the inputs for growth of the growth trend of the economy. So I guess Singapore is doing very well because of that, right? So labor productivity, you have the idea of total factors of production. I hope you might still remember this in your economics class. Your economics professor probably talk to you about some graph and how you calculate total factors of production. So I'll not really talk about it too much. All right. Capital inputs. So what's your investments per head? So interestingly, actually, also Singapore has very high capital input. Meaning what? If you are in the HR industry, you know that we spend a lot on training, or we have a lot of funds set aside for training. I believe it's one of the highest in the world that we actually train our labor force very well, right? and because of that, our productivity is quite high. Right, so there are a few things to just take note about trends. Economic trends generally are quite stable. There might be some shocks from, let's say, the COVID, but they are usually short-lived, right? And trends generally do not really change so much. Well, of course, there are black swan events that we talk about, like the COVID or even the war in Ukraine. Those are things that seems to be dragging a bit longer than expected. So, again, I guess this is a bit of a repeat. We talk about what are the pro-government policies for growth, right? We talk about just now, I mentioned about labor policies. Then we also can say about minimum intrusion to the private sector. So how does this work is that, if you do like read up a bit on the news in Canada or in the West, right? Generally in the West, there's a lot of protectionist kind of policies. Basically, they want to protect local businesses a lot, or local labor. And the process of protecting the local labor force, they necessarily had to cut back on a lot of these openness policy, and therefore the government policy kind of now intrudes into the private sector, right? So basically what happens is that, let's say, if you want to get a job in London, right, you definitely need a company to sponsor you a visa in order for you to be even be eligible for a job. But at the same time, if you cannot find a job yet, then you can't get a visa to even apply for the job. And then most jobs require you to at least have a visa to work in London. So it becomes an egg and chicken thing. And because of this government policy, it has actually intruded on the private sector. So if any of you are like studying the job market in London, you notice that there is a high demand for skilled labor, but there's not enough supply, especially in the finance sector, if you notice, or I think even in nursing as well, right? Because the government requires you to have the visa, but in order to have a visa, you need to have a job. So yeah, it becomes very difficult, right? So there's a lot of intrusion into the private sector in London, of course, Brexit and all, it causes impact as well. Okay, so yeah, there we talk fiscal policy, tax policy, etc. All right. Support for human capital development. I mentioned about the upskilling and like how Singapore is very good. I have a lot of funds for training. All right. Some other forecasting models. We have the econometric model. Basically, what's econometric model? Econometric model, simply put, is just running various regression. So just a quick recap of what regressions are. Regressions are basically, how I like to think about it is they are, your equation of line. Remember y equals mx plus c, right? But remember that y equals mx plus c, you only have one x, right? One independent variable, right? Independent, so one x variable. So when you run the regression, you have multiple x variables. So x1, x2, x3, or xy. You don't usually no. So x1, x2, x3. Yeah, usually that's how you use it. So that's a econometric model. So you include many various factors. You have So you can run almost like a prediction, or like you try to explain certain economic kind of factors that might be affecting the economy. We talk about these leading or lagging indicators. Remember T-1 and 1, and yeah, subjective judgment and all, right? So I won't go through all of this. You can just look through it. If you have any questions, feel free to just reach out to me or ask me the next question. Basically, it's just a quick summary of some challenges they face. Some, again, we talk about psychological threats, some biases, etc., etc. So I won't go through this. Okay, so let's think about some asset class returns and how it's being affected by the economic factors. Again, this might be a repeat of what we have covered a little in the last two lectures, but it's being placed here to just show how the studying the economy can actually impact your kind of asset allocation that you have chosen. So cash and cash equivalent, we talk about how it reflects the or hedges against interest rate when interest rate is inflation, and because inflation is correlated with interest rates, so when interest rate is high, you want to have more cash and cash equivalent. So your risk-free bonds, generally has no risk. So government will not default, or usually do not default, right? And during recession, it's always good to go into risk-free bonds. Right, so these are just for you to read. Okay, so this is interesting. And I think we have not talked about this. Bond linked to inflation. So anyone heard of TIPS, TIP? So if you just type in the group chat TIP, so TIPS, I think there's S. So TIPS are like inflation-linked bonds, and they're very, very popular to help, first of all, hedge against inflation. So I'll explain a bit more on this. So how does it work is that inflation is measured by your price consumer index, right? CPI, a consumer price index, CPI. And how CPI is measured is what is the cost of a standard basket of goods sold in a country. So your inflation-linked bonds, right, basically tag the coupon payment to the CPI of the country, right? And in doing so, right, your coupons fluctuate with the CPI, and therefore you hedge against your inflation. So this is a very popular instrument to use, especially, okay, this is quite important to take note. You only use these when you are experiencing inflation, meaning that prices are going higher, right? When you're experiencing deflation, when prices are going lower, generally these bond linked with inflation or TIPS do not perform very well. All right, so I repeat again, they are good for inflation, but not good for deflation. So it's something that you need to take note of, right? So yes, you can recommend this to your to your client, but only when the economy is experiencing inflation. So maybe just a side track, right? What's interesting as well is, anyone knows how CPI is calculated, price consumer index? I mentioned a bit about this basket. Any geography kind of major in I don't know, A levels or O levels, human geography? No. Basket of necessities. Yes, correct. It's basket of necessities. Yeah. Okay, so we do know that it's a basket, has different goods, right? So what's interesting about this basket, right, is that the basket changes with countries. So this is very interesting. So when we compare CPI of one country to another country, we cannot actually do that, right? Because each country will be given a basket, and the basket depends on the kind of like normal goods and services that's being used in the country. So for example, in Singapore, right, the basket could include goods and services, could include majority service industry. It could goods could be like restaurants, yeah, the different categories, right? But let's say we are going to compare this basket or the idea of CPI to, let's say, a country like maybe Australia, right? Australia. So Australia does a lot of like farming, mining. So their goods and services are very different. So the services that they provide is more mining services, farming services. And so what's interesting to know is that every basket for the countries are different, and comparing CPIs across countries can be a bit problematic when we do it that way. So because CPI is calculated differently, inflation becomes a bit tricky concept when we use CPI, right? So linking back to this idea of bond linked with inflation. So your bond, your so-called your bond that is hedging the inflation should hedge the right inflation index that you are in. Meaning what? If your client is in, let's say he's in Australia, he's a Singaporean, but his income is in Australia, you want to make sure that the security that you hedge or the bond linked to inflation, this kind of instrument that you use should be hedged with the CPI of Australia and not Singapore, even though he might be Singaporean, right? Because you know that his goods and services are generally from Australia. Let's say he's living or residing in Australia. And so it necessarily reflects the inflation in that country rather than Singapore. All right. Okay, so let's think about a bit on defaultable bonds. So nothing too exciting again, just a bond. So I'll not go through everything, but then just to explain to you, basically defaultable bonds are any bonds that are not government bonds, right? Government bonds are typically said to be risk-free, cannot be default because the government central bank will not default on their bonds. But of course, that's not always true, right? We know after the 2008 financial crisis, that's not true, right? But let's just assume that it is true, then your defaultable bonds are those corporate bonds only, all right? And then corporate bonds, the risk is on default, right? Whether your company defaults at the end. Emerging markets. So for emerging markets bonds, even though they might be issued by the government, they can actually default or have high default risk. So generally, when we talk about risk-free bonds, they are more of the developed market, like the US, the UK. Those are usually considered risk-free. So what's interesting is that, see, they say that emerging markets usually borrow in foreign currency, and since government cannot inflate its way out of that, default risk is very high. So this is an interesting concept of, yeah, I think India is an emerging market, right? So what does this mean? It's a very interesting concept that if you are a money producer, so there's only typically the researchers typically agree that there's one major money producer, which is the US, right? So the US can inflate their way out of that, meaning like they just print more money, right? Because everyone just use US dollar. Now, but in the emerging market, because they are using, let's say, the US dollar, they cannot print more of their local currency to pay out this just called US dollar bond, right? So if they go bankrupt, they go bankrupt, and that's all, right? The whole country just goes bankrupt. So if you're interested, you should read more on money producer, or this other thing called modern economic theory. I think it's modern economic theory, basically talking about money producer and how do we value money. Okay, so again, there are various things I won't really go through. We mentioned many times. There is common shares, there's real estate, and then there's currency. So this is interesting. So real estate, common shares we've mentioned many times already of the type of assets, but currency is also now being used as as a way, as a class of assets to trade. In fact, actually, even individually, nowadays you can actually trade on currency. So I'm sure everyone heard of Revolut card. Have everyone have Revolut card? Or there's another one, a similar competitor of Revolut. I can't remember what's the other name, right? So if you have the Revolut card, you know that as a very simple kind of or a less sophisticated investor, you can actually use the Revolut card to earn money by trading currencies, because you know that if you're familiar, there is very low charges on the card, or even no charges if you trade below, I think 4,000 or 5,000, something like that. So basically, yeah, I have friends that earn quite a lot from just trading on the Revolut card, and it's free somehow. Yeah. All right. So when we trade currencies, just one last point to take note is that again, you have to have a market expectation of what the currency is, or the trend, and then you trade on it, right? So we go back to what's the market expectation. Okay, so investment styles, there is a spectrum from passive all the way to active. All right. And we'll go in detail, right? Like what are the difference? So again, I'll not go through every single point here, but I just want to mention again that passive style actually nowadays are more and more popular. I think what I mentioned about ETFs, yeah, they're very popular. Or now robo investing. So basically, you're just talking to a robot and then they invest it for you, right? So those are very passive kind of investments. Generally, it's good for investors that are less sophisticated. Maybe your client could be more conservative. They don't know too much about the finance industry. Maybe they're scientists, right? They do not know too much, but they just want to like invest their money to hedge against inflation, let's say. So they approach you, and then you can just advise them, okay, you know what, maybe let's do a passive investment style, because if you do active, you know that you have to incur a lot of various costs, right? Advisory costs, transaction costs, bid ask spread costs, a lot of costs. So maybe passive is good. Of course, at the end of the day, if you believe in market efficiency or efficient market hypothesis, that's the year one module. I hope you still recall efficient market hypothesis. Maybe it gives you nightmare now. I don't know, but if you still remember what's efficient market hypothesis, it mentioned that if the market is fully efficient, the only returns can get is basically market returns, right? There is no special private information or anything that you can actually capitalize on. Okay, so something I want to highlight is also about this idea of tracking error. So basically, tracking error is how close do you track the benchmark portfolio. So the closer you are, the better, right? So the closer you are, the error is lesser, lower tracking error, right? So how much do you track the benchmark return? Generally, if you're passive style, you want it to track as much as possible. Okay. Now, active management is the reverse. You have someone that manages all your funds, blah blah blah. You manage. You make sure that you capitalize on the differences in the market. You check the market every day. You do technical analysis. Hope some of your maybe have experience or even might be doing technical analysis where you actually look at Bloomberg, you look at the graph, you plot certain things, you look at the candlestick graph and all those things, right? So those are more like active. You are like actively trading the stocks or trading the securities. Semi-active now again is increasingly more popular because later we'll talk a bit on the method to use, but basically what you're doing is you want to track the index, but at the same time you want to get certain premium or certain higher returns, right? So it's almost like you want the cake and eat it as well. Basically, you're very greedy. Okay. All right. So type of equity indexes. So a lot of information here, don't worry. Again, at the end of the day, I told you all this other information so that when you read cases, you kind of can identify what indices or what kind of, basically what thing they're talking about, right? You want to identify certain traits or components. And so we have the price weighted. So price weighted index or indices are basically you're weighting the stock price, and based on the different stock price, you will invest certain proportions of your funds, right? So you basically weighting the portfolio based on the price of the stock. So there are some advantages and disadvantages. Stock price are readily available. You can construct this portfolio based on stock price, right? Disadvantage, of course, stock price changes every day. You might need to do a lot of changes or buy sell kind of thing. Of course, then when the stock split and then the price split by half, right? Then you have to reweigh your portfolio. Of course, it's buyers for highest price. Okay, all right, so let's look at this quick example here. Not too complex. It might look a bit like daunting, like so many calculations, but not too complex, so don't worry. Basically, we want to calculate what's the return of, first of all, each stock. We want to calculate the returns on the portfolio, and we want to calculate the price weighted index. So we are going to form an index, a price based on price. Right. So first of all, let's do part one. So part one is here. So return on stocks, pretty easy, right? You just take what's the beginning price minus the ending price divided by beginning price, or you just take ending price divided by initial price and just minus one, right? Now, portfolio value, what we can do is we just add, what is the current initial value of your portfolio, right? And then, so initial value here, and then what's the final value of your portfolio, right? And then you find, okay, so what's the change in your portfolio value? All right. So now, what's interesting is more of the price weighted index. So by price weighted index, we measure the initial price, all right, and the final price here, all right? And then after that, we calculate what is the change in the index value, right? So you just take the final divided by initial minus one, and you notice that your percentage change index value and your change in portfolio value is the same thing. Any questions on this price weighted index? We're good. Okay, maybe we'll do one more, then we will take a quick break. Okay, so let's look at value weighted index. So just now we talked about price. Now, if you want to do value, then we are actually doing the same thing, but just on market value, right? So what's the market value of the stock? And then based on the kind of value, you want to put certain weights in your portfolio. All right, and then on top of that, there's this thing called float weighted index, where you actually take what's the market capitalization of that stock, but you multiply it by what is the free float factor. Free float, okay, so what is basically the amount of stock that is available for sale in the market, right? So there's a free float adjustment factor. So this float weighted index, right, is actually I wrote here, is actually the gold standard. Basically, it's the best way of indexing the portfolio, and it's being used by S&P 500. So it's one of the best method to use to weigh the portfolio. Because you take into account, first of all, the available stocks in the market, at the same time, what's the market capitalization. So you minimize tracking risks and portfolio returns. Yeah, all this you can just look through. Of course, the bias is that, as you know, S&P 500, they are the top 500 companies, right? So it is biased towards big companies with big capitalization. So if it's a small company, probably will not be on the S&P 500. All right. Again, this is the same question, but then now we are given the information for value weighted. All right. So calculate what's the returns for each stock. This I will not go through. Basically, is the same thing. You just calculate what's the value. Now we know that a portfolio, you want to calculate the value or the return of portfolio that holds 10% shares in each firm. So we know that ABC and XYZ will hold 10% each. All right. So because of that, we can calculate what's the value of the 10% of each at the initial price or initial value. All right. And then we multiply by what's the final value here, final portfolio value, right? By the 10% or so. And then we can calculate the change. So we can use the value weighted index based on the initial value also. We can use this concept where we use the initial value here. All right. Of course, the initial is 100 million. And then we have the value outstanding, and then you take the final value. All right. And then multiply by the initial value. And you notice that the change is the same. So, yeah, the calculations are quite simple. What you just need to take note of is that what is the question asking you? Are they asking you for value weighted or price weighted? So based on that, you need to make sure you plug in the right answers. Okay, maybe we'll take another 7 minutes break. We'll come back, let's say, in 7 minutes time, which is 8 or 9 or 12, right? Then we talk about equal weighted, and then we'll carry on, right? So let's have a quick break. As usual, if you have any questions, simply type it on the group chat. All right, welcome back. How's everybody? Still surviving? I hope it's not too dry. Quite a lot of details to talk about. Everyone doing well? Everyone's okay? Yeah, everyone's fine? Or everyone's have already fallen asleep since a Friday night too. I guess most of you are working. Okay, good. At least one person is still online. Okay, so let's start and let's continue. There's a few more details that we have to cover today. Yeah. All right. So moving on, we have the equal weighted index. This one I'll not talk too much. It's very intuitive. Basically, you just have equal weight throughout all the companies, right? And that's all. Okay, just equal weight. Of course, it's not good because you're not using any kind of like matrices, right? To consider things, right? You're just like equal weight throughout. So there's no, yeah, it's not so good. Maybe I'll not do this. Maybe you can just have a look at this. It's the same calculations. Now you invest 30 million and then you just do equal weight, right? Okay, so let's talk about a bit of some passive investment vehicle. Just now, or most of your, or probably all of you know what's ETF, right? Or mutual funds. Now, the interesting thing is what is the difference between mutual funds or index mutual funds, I mean, and ETF. So I believe all of or most of you could have some experience or knowledge of what is this. There's this Tiger trading. Is this app where you can, it's called Tiger or something, where previously they were giving free Apple shares, and then there's this other one, right? The red color one, I can't remember what's the name, or orange color one, where you can actually trade things. Mumu, yeah, right, Mumu, that's right. And Tiger, right? So if some of y'all are into or have the app, you know that you can easily buy ETFs, right? And most of them are ETF. So the question, right, is that, okay, if I want a long-term investments, right, should I choose index mutual funds or should I choose an ETF via Mumu or via Tiger Broker? Anyone knows the answer? So if I want a long-term investment, which one should I choose? And maybe which one is better? Or ETF? Okay. Remember, you're buying ETF via Mumu. So and it's a long-term investment. So unfortunately, actually, it is index mutual funds. All right. Okay, let me explain to you why. Maybe you can implement this in your own trading or investment strategy, right? As you know, because it's portfolio management, so you can manage own portfolio, right? It's not about managing clients, so it's beneficial for you. Okay, yes, ETFs are very good for, I would say, short to medium term, especially via Mumu or like Tiger, right? But if you're going in long term, remember, is like 10 to 20 years, right? Now, whenever you buy a ETF from Tiger or Mumu, you are technically not owning the ETF. Okay, later I think the next slide we'll look at this, explain why. Right, you're actually not owning the ETF or the index that the ETF is tracking. And the problem is you are actually taking on the default risk of the company Mumu or Tiger. What does this mean? If Tiger or Mumu defaults, your money just goes down the drain because you technically do not own the index, right? And so that's a problem if you are taking a long term, right? Because who knows, 10 years later or 20 years later, maybe the company might have liquidated or have been acquired and a lot of things might happen, right, in 10, 20 years. But if you're doing a short term meaning 1 to, let's say, 8 or 9 years, maybe that's all right, or 5 years, maybe that's still okay, right? So owning the index becomes very important. Owning means that you actually buy a proportion of the index. It becomes very important when you think about long-term investment, but less important when it's a short or medium term. So again, I want to mention that when you buy into Moomoo, let's say S&P 500 ETF or Moomoo, you do not own the index. You own basically the broker, which is Moomoo, owns the index, and you are buying, you are getting basically paying Moomoo for that. And then the question is, you do not know whether they actually own the index. So they say, okay, yes, you buy into S&P 500, but they basically just take your money and they invest anywhere else. They need not actually buy S&P 500 index and pass you the certificate to say that you own the index. Okay, this is a very important concept. And this is the main difference between index mutual funds and ETFs. All right. Okay. So of course, because you do not really own the index, you have a lot of benefits for ETF, right? I think some of you mentioned lower expense ratio, you have tax efficiency, you might be cheaper, you have less license paying, and then especially when you're by S&P 500, right? You do not have all the FX conversion, FX risk, right? But buying a US index. So there are a lot of benefits, right? But yes, so you're right. So quickly withdraw money after you meet your target and don't be greedy. Remember, don't fall trapped into psychological bias. If you're making a loss, don't fall trapped into sunk cost bias as well. So yes, that's the difference. So how the ETF work? Basically, it's structured like this, right? So you have a buyer, all right? They have an ETF, and then you have like these capital markets where you construct the ETF, right? And this construction ETF gives you the basket of securities, and the ETF advisor will construct this ETF. And basically, what you're doing is you're buying. Okay, this is in a mutual fund setting, so not a broker setting, not like the Moomoo, but in a mutual fund setting, you're actually buying a unit of the ETF, which is what you want for a long term. So you are buying like a real share, basically a share of the ETF. But in the case of Moomoo, you are buying through a broker, and the broker need not actually buy the ETF for you. They basically just track the ETF and give you the return based on the ETF. They can use the money for anything else, right? So ETF is still not too bad. You have a short-term strategy, and because they track a basket of diversified portfolios as well. Okay, so I just provided you this. Don't worry, don't need to memorize all this. It's just for our own knowledge, right? What are the ETF? I think the very popular ones are QQQ. If you are on Moomoo, you probably know what's QQQ. And there are various ones here as well. Okay, I think a lot of people buy QQQ. It's actually quite good to buy now. I think it's quite low. Okay, so let's look at this. So what's index and mutual fund? The difference and the stock. So ETF provide diversification, so fine, whatever, we don't really bother. Sales charges, okay, mutual funds, there are of course more charges, right? The expense ratio, you see ETF is much lower. Through a broker, can you see that if you buy through Moomoo, usually take T+3, means the transaction date plus 3 days later, then you get your ETF. Mutual funds, you buy immediate, you get it immediate, right? Of course, both we do get dividends. So something to take note also that most people do not realize that if you buy ETF, you do get dividends. All right, so it's still not too bad. But the problem is with tax withholding. So if you are buying S&P 500, you have a withholding tax in the US from your purchase of your S&P 500, and the tax in the US, I think, is 30%. It's quite high. So your tax withholding is very high, which is why people say that, you know what, actually Singapore is very friendly to investments because, our corporate tax is only 17% and dividends are not taxable. I think capital gains are also not taxable. is only taxed at our income tax rate. And our income tax rate is one of the lowest in the world. So, yeah. Fun fact, just a side digression, is that if you notice, right, in Singapore, when you buy something, you buy anything like groceries and all, there is no separation between the tax and the amount you pay. So when you travel to, I think, the US and Americas, not in Europe they don't have this, but if you travel to the US, right, you notice that whenever you buy groceries, tax is not included in the price stated on the shelf. So when you go to buy groceries, right, you buy everything already, right, and then suddenly you see one big chunk of tax on your groceries. So this is not about restaurants, but groceries. So yeah, it can be quite surprising sometimes. Yeah, unless you declare in CPF, yes, of course you declare, because sometimes they can't track. So should we buy ETF? Yes, it's good, it's efficient, it's transparent, it's very flexible, you can sell it off the market anytime, it's very good. I'm a strong advocate for ETF if you want to buy, because I find it very diversified. It's quite good. If you're a low risk, conservative investor, it's good for you. Okay, so remember, again, I want to bring it back to the concept, right? Why are we learning about all these things? Is to give you ideas when you read cases or when you meet clients on what can you actually do, right? You can suggest some ETF, you can suggest currency, FX, kind of investments, etc. Right? Okay, so approach for index portfolio. Generally, we want a full replication, so you're reducing tracking error, right? So you just track the index all the way, and which is what you want. Yep, you have a question? No? Okay. All right, stratified, okay. What are UTs? Unit trust. Actually, they are not ETF, but they are also a diversified portfolio, but it's different. It's slightly different. It's almost like mutual funds, right? They are like ETF, but then they work differently. I believe unit trusts are also not sold on the exchange market. You have to buy it through either an agent or bank and stuff, because unit trusts are structured or created by the bank. So they're a bit different. They are not traded, if I'm not wrong. Right? If anyone knows the more solid answer, do step in, right? Okay, so for stratified sampling, we can divide index into a number, of so basically, creating so stratified sampling is like a statistical technique. So you basically divide a big pie, right, into various strata. So call it stratas, meaning certain small components, and each of these components or dimension represents can be like, let's say, an industry, right? So you divide them into different stratas, and after that, you give certain weights to the stratas or the divisions, and from there you form a portfolio basically from their stratas. So that's how you do stratified sampling. So it's more like a statistical technique. And what's interesting about this stratified sampling that's not stated here is that when you do stratified sampling, you reduce your uncertainty of okay, so you reduce the uncertainty of not representing the population. Okay, so this is a very statistical thing. So if you are interested in statistics, you notice that if you want to reduce, because at the end of the day, you don't have the population, right? You don't have the population, let's say population return, because we always use a sample to estimate the population. But when you do stratified sampling or stratified kind of like statistical method, in the process of doing it, right, you reduce the uncertainty that the sample will not be the population. So this is the very unique thing about stratified sampling, and it's only works in stratified sampling. All right. So I will not go into details of how the mathematics of it, but if you're very interested, you can either Google and check. There's a proof to show that through stratified sampling, your uncertainty reduces. All right. So if uncertainty reduces, you're closer to the portfolio, the index. Yeah. So what's interesting is that some certain regulations might require you to diversify certain components of certain industry or certain types of stocks, etc. So using a stratified sampling, we can make sure that we fall into the diversification requirement. Optimization, we talked quite a bit on this previously. Remember the mean variance optimization. So mean variance optimization is one method where we want to optimize the risk based, optimize the risk based on the level of returns that we seek to achieve, right? So in the same thing, this optimization, we can optimize various functions to get lowest risk for the given level of returns. Okay, so this is just a very quick example. The answers, we'll just discuss it. It's not too complicated. So this example is that we consider investing to these mutual funds, all right? That's classified generically under the term growth and income. Using a public data sources, he gathered the following information about the mutual funds in question and how should we characterize these funds. Anyone would like to it's just like a 1 or 2 words answer, right? Based on the funds and the benchmark. So what kind of fund is this? If you notice, you can just type out the answer. So how should we characterize these funds? Anyone like give it a try? So you notice that your sectors are quite similar to your benchmark, right? Okay, yes, you might have a bit of stratified sampling technique here. At the same time, it is almost like an index fund, right? If you can think about it, can you see that it tracks the market index quite closely? There is some difference, I would say. Yeah, so there's a bit of tracking error here, but it actually tracks quite closely. And someone can see the EPS is very similar. EPS growth, these are all very similar as well. So dividend yield, so it's almost like tracking the index. And at the same time, they use a stratified sampling, that's right, to create the funds. Okay, so that's the answer. It's just a 1-2 words answer. That's all. Okay, so active equity management. Basically, if you're active, right, you need to have a lot of resources because you're active. And when you have a lot of resources, so that you can track a lot of things. Remember, we talk about you need to track the market, you need to talk about inflation, you need to think about government policy. So you need to think about everything, right? And then we need to consider the type of stocks and everything. So basically, you need to have a lot of resources, and most importantly, you need to have a long-term concept or long-term philosophy, in the sense of what do you feel, first of all, the market, how do you feel the market will respond, and second of all, what kind of stock is it, right? And so we'll look at these two ideas of value stock or growth stock. Okay, so the objective is basically now, right, when you are doing active management, you are saying that I am actually better than the market. Meaning what? I don't want market return. I want alpha. I want like more than the market. So you feel that you have you feel that the market is inefficient. So if you recall your year one module about efficient market hypothesis, this would be considered a weak form or semi-weak form efficiency market, right? If you don't recall, try to flip back your own notes on efficient market hypothesis. So basically, you are assuming that the market is inefficient, and because of its inefficiency, you can capitalize on this inefficiency and make a higher returns. That's what you're hoping to do. All right. And how do you determine which component is inefficient? That's why you do all your analyses. You look at the inflation, you look at the market, you look at the stocks, right? Look at the company, the industry, the business cycle. You look at all these things, right, to determine the inefficiency of it. All right, so these are some reminders or some kind of questions that you should ask when you read case study. So remember, at the end of the day, right, whether you choose active or passive, you should always fall back on your IPS. So I'm going to be very long-winded here, right, to keep on mentioning the IPS, because as a portfolio manager, that is your lifeline, so-called, because everything you do is based on IPS, right? So you need to determine what's your risk, your investor risk appetite, remember, risk willingness. So you don't basically, you cannot just say, oh, one day I'm doing passive, next day I decide to do active because I like it, right? Or because I think the market is good, so I want to do active now. So no, you can't do that. You need to fall back on your IPS based on your investor's perspective. All right. Okay. So we have remember I'd say that we are looking at two types of stock. So value stock. So what's value stock? Basically, value stock, right? Okay, there's this one whole chunk of thing, but I'll just explain to you the intuition or the concept of value stock. So value stock means that you feel that this stock now, first of all, is undervalued. Meaning what? That actually the real value is much higher, but the market is saying that, oh, it's only value, let's say, $2, but actually you think it's $5. So that's value stock. So the market is undervaluing the real value of the stock. All right. So there's this value stock. So if you identify this value stock, basically it's an inefficiency in the market. And if you're an active manager, you want to capitalize on this and buy a value stock. All right. So you can read all this. There's just like very nice explanation, but that's the concept, right? What's a value stock? So there are some rationales or why you want to buy a value stock. So generally, a value stock has low PE ratio, right? Price to earning, meaning, right, the price is very low, but earnings is very high, right? So what does this mean? It means that the market is, because remember, price is related to market, right? So the market is saying that, this stock is not so good, it's very low price, but remember, earnings is the intrinsic value of the stock. So the earnings is very big. So the intrinsic value is very big and your price is very low. That's why your PE is low. So when you see a low PE stock, maybe it's a value stock, right? Of course, the risk is that why the market say is low is because it's actually a bad stock. Maybe that's the risk, right? It's terrible. That's why it's so low. All right. Of course, the rationale is that if you buy a value stock, you expect the value of the market to match the intrinsic value of the stock. So the price will increase over time, and that's what you expect. All right. So intrinsic versus the market. So because of some inefficiency, that's why the market price it low, but the intrinsic value is very high. All right. Any questions about this concept of value? What value stocks are? All right. If no, we'll move on. So I'd like to talk about one more, growth stocks. So that's not value. We'll talk about how intrinsic and price, right? Now, when you think about growth stock, means that this stock is expected to grow in the future. That means you will get more and more, get more and more expensive, let's say. So if you buy into this stock now, your returns will be higher in the future. So what this growth stock could include is like a lot of I don't know, maybe new startups, IPO startups, or maybe this company have a new R&D, right? R&D kind of like, for example, in the healthcare when we had COVID, right? There was a new vaccine. Let's say you know that the vaccine is going to happen, going to be rolled out. So you can't buy into this growth stock where you know that Pfizer stock would grow in the future because they are the forefront of, let's say, vaccine research, right? So these are growth stocks. So you expect it to continue growing throughout the business cycle. And of course, now, if you do have the expectation of Pfizer having to roll out new vaccines to counter different variants of the COVID-19, then perhaps you should buy into the Pfizer stock because it's considered a growth stock, right? To you, of course, you must have your own expectation. Of course, at the end of the day, using the example of Pfizer and COVID and the vaccine, is that, yes, okay, you have the perception that it's a growth stock, but perhaps maybe COVID becomes so normal that nobody cares anymore. Nobody gets vaccinated for it, let's say in 5 years' time. And therefore, it might not be a growth stock after all. The growth didn't materialize, right? So that's one of the risk of this idea of growth stock. And so, the share price might not increase because of that. All right. So this is a quick summary of what's growth and what's value. Basically, value is the inefficiency in the market. Growth is that you expect a certain exponential increase over time, right? Because of certain factors. All right, so we have this very quick example again, not too complicated. Is again one or two word answer kind of thing. Let's look at this. So basically, you have a firm that has been tasked to manage active portfolio with a developed market mandate. All right, so the mandate is only to invest in developed markets. You can't go into emerging markets. All right. So Galicia is a well-known value manager. So he's a value manager. So he basically looks for value stocks, right? So Varga performed some, return-based style analysis and find the following results in the past 2 years, each quarters. Okay, fine. What is the reasonable conclusion that Varga reached regarding the investment process? So if you notice, the value is decreasing, right? But the growth is increasing. So what does this mean? The investment process, right, is that we are actually using more of a growth stock or growth strategy. We are expecting the MSCI to grow, right? We're not using a value, because if you are using a value strategy, your value should increase over time, right? But no, it's actually what you are focusing on is a growth factor. So the strategy or the investment process is more of a growth strategy, right? You're picking a growth stock strategy. All right. Again, the answers are just being discussed here because it's just a one or two words kind of answer, right? Any questions for this? Very good. All right. I think this is one of the final few components of this lecture. So we talk about equity style. And we remain equity style. So basically, we think about the market-oriented style. So we're no longer talking about whether it's growth or value, right? We are thinking about what is the kind of market oriented style of the equity. So there's quite a few kind of style. It can be growth, a style rotator. There's various ways to so-called be an active manager in the market, or growth at reasonable price. So basically, you favor companies that have a certain above average growth, or rotator style means that you rotate within maybe, let's say, different industry. So it can be an industry rotator. Basically, these are just different styles being used. So these are just, I won't really go through everything and just read through. Okay, so just now we already talked about the styles. Now the question is, how do you identify the equity style? All right. So first of all, you look at the return-based analysis. So return-based analysis, I'm just going to flip that here. So do you notice that these are the returns? So basically, we look at returns and then we determine, okay, based on the current returns for the past 3 years, right? What kind of style is it, right? Where does it point us to? So yeah, we look at the portfolio, and we measure the style. Yeah, nothing too much to talk about. Yeah. Okay, I want to talk about this small thing called the R square. So when we do return-based analysis, right? And let's say we want to measure, we do, again, I'm going to use the idea of a regression. I hope everyone is comfortable with a regression, basically y equal mx plus c, but you have more than one x. So we actually do a more like a prediction line, right? So when we think about R square, right, is how good of the line that fits the data that's provided, right? So a line that fits the data better has a higher R square. So the R square basically measures how well if you loosely saying, how well your prediction line can actually show your predicted outcome based on the data. So a high R square is better, right? So measures the style fit. So if your R square is very high, the style fit is very good, or it matches the prediction in the future. All right, so we can use a holding-based analysis. Again, what we are doing is we are trying to determine what style is it, right? So basically, you can look at various factors. Remember, just now I mentioned P ratio. How if we are looking at value stock, the P ratio might be very low, or maybe you look at a growth factor. So all these things help you determine, okay, what style is it, right? Whether you have certain sector weighting, does this reflect more of a stratified kind of sampling? Of course, then you can have your modeling decisions as well, right? So based on your modeling, you can determine what kind of style. All right, going to move on. So based on your holding-based analysis, what you can do is this thing. Okay, what's interesting here, right? You can read through, but what's interesting here is this thing called the Morningstar box, style box. So how does this work, right? Is that, let's say if you have a basket of, I don't know, this one has like what, maybe 100 stocks or 80 stocks, right? Then what you do is you plug in the number of stocks that considered value, growth, or is it a core stock, and whether it's mid cap, large cap, or small cap. And by plugging all this into this matrix here, you can kind of determine, okay, on average, what kind of style it is, right? So on average, oh, maybe this looks like more of a growth strategy, right? A growth mid cap strategy. So that's how you determine the style, right? This is just one method of doing it. So what is a style drift? Style drift, right, means that, for example, if your your IPS say that you can only invest in value stocks. What happens if your investment manager, or if you are a portfolio manager, you drift from the IPS? So instead of doing value stocks, you do growth stocks. Now, this obviously will contravene the IPS that you have agreed with your client, and you should never do that, right? So always fall back to IPS. And why we are talking about style drift is to make sure to kind of remind you, right? Eventually, if you do fall into a portfolio manager role, you should avoid style drift. So stick to the style that's agreed upon the IPS. Right? Okay, so the long short investment strategy is something more interesting to talk about. So most of the time people think about longing stocks. I think last lecture we already talked about how we do short selling, right? And the problem with short selling, right, is that not everyone can do short selling. First of all, you need leverage, you need liquidity. Remember, we talked about how short selling is taking leverage, and it's very dangerous if you don't have enough liquidity, because when you need to close off your short position, in case the market is going badly, you need to have the liquidity to close off. If not, you go into bankruptcy, basically. So using a long strategy is available for everyone that has the money, but not everyone can do a short strategy. And because not everyone can do a short strategy, the short sell market is actually has more inefficiencies and more things that you can, as an active manager, you can capitalize on. And so if you're working as a portfolio manager, generally it's a big company or a big bank or a big asset managing firm, and therefore you are open to short selling strategies. And if you are able to do short selling, then you should capitalize on this. So you do a long short strategy where what you do is you hold a long stock, yeah, and then you do a short sell as well. So you capitalize on a dual alpha. All right. So I'm just going to move on to this part where you have two alpha, in the sense that you have an alpha from choosing the right stock to invest. Let's say you choose a value stock and you long the stock, but at the same time you get alpha from shorting another stock. And you know the short sell strategy, right? You short it in hope that the price might fall, or that you use the money to buy another stock. So you can get double alpha. All right. Of course, the risk of a long short strategy is that if you're going to short a stock, you are being open to the leverage that you are taking. Because remember, when you do a short, it's a negative weight, right? So you have a double weight. So you're exposed to double. Now, this is very interesting. A market neutral strategy. I believe one person, right, in the class has taken the structured products or derivative class, or maybe not more than one person, but at least one person has done it, right? So perhaps you have more knowledge on this, and the professor has went through in a lot of detail on derivative and structuring products. One way to structure a product is to use this long short strategy to create a market neutral instrument. All right. So how do you do this? You long an undervalued stock and you short an equal dollar amount of overvalued stock in the industry. So you do a long short. So what does this mean? When you long the undervalued stock, the stock would increase, right? And then when you short an overvalued stock, the stock would most likely decrease over time, right? So because of that, your risk is almost entirely removed, right? So basically what you do, you are removing now even the systematic risk. Okay? And when you do that, you are basically getting risk-free returns. And when you get a risk-free return, what you're interested in is your risk-free return higher than the risk-free instrument given by the government, right? The long-term government bonds. Is it higher? Because remember, risk-free instruments in the market has different rates as well, right? It's not like standardized across the whole world. The risk-free is 5%, no such thing, right? Risk-free is different. So by doing this long-short strategy to remove the to get a market neutral instrument, we are actually determining what is the risk-free rate in the country. And this is called a synthetic risk-free rate, right? So this is a very interesting portion of the markets. So, for me, I'm quite interested in like structured products. So you can actually structure a lot of different kind of product strategies, right? And this is one of them. So basically, what structuring means that you're creating something that is artificial. And because it's artificial, but you create this artificial by using various kind of trading strategies. And in doing so, right, you can actually gain more through this through the structuring. Right? Any questions for this? This is quite interesting. The market neutral strategy in structuring of products. Any comments? Personal experience of structuring products? No? Okay. All right. Maybe it's a bit heavy. Let's just a bit more. We'll push a bit more, right? And then we're done. Okay. So let's talk about semi-active equity strategy. Maybe semi-active is you want to have the cake and eat it as well. So you want something that tracks the index and something that at the same time gives you alpha returns. All right. I won't go through all the detail. Basically, you want to design a strategy that outperforms the benchmark, but at the same time, you want to make sure that you also track the benchmark. So it's like, yeah, you want both, right? So the rationale in doing so is that you want to attempt to separate alpha and beta contribution of a portfolio. Okay, this is an important concept. Why? So when you track the market, you are getting beta returns, right? Because you are taking systematic risk. Now, at the same time, you want a semi-active so that you can also get alpha returns. And so there is so in doing a semi-active, you are able to first of all determine which portion is alpha, which portion is beta. And because of that, you can allocate resources and you can even charge the client in a very transparent manner. So you say, oh, I'm doing X percentage beta returns, and so you will get X percentage returns, and the rest are alpha, right? So this is the thing about semi-active strategy. All right. So these are various ways. I talk about derivative based. So these are like structured products. Okay, we'll mention about this core and satellite strategy. And let's look at it. Okay, so another small portion, it's not too complicated kind of mathematics, is that when we think about semi-active kind of strategy, there's two components, the active and the passive, right? So the information coefficient, this is more of the passive side. So what's the correlation between your forecast and actual? So you're tracking the benchmark, right? Multiplied by your investment breadth. So your investment breadth, right, is more of the active side, right? So this calculation, this information ratio basically gives you the degree of semi-active strategies in you. So for example, if the information coefficient is low and the investment breadth is high, you know that it's maybe more active, right? Although it's semi-active, but it's more active because you have more active investment decisions. Now, if it goes the other way where the information ratio is low, meaning that the let's say the information coefficient is low, information coefficient is high, means that you're doing more tracking, and low investment breadth means that it is less active strategy. Okay, so I just want to quickly mention about this core satellite approach. Again, is another way of doing semi-active equity investment where you have a core and you have a satellite. So a satellite orbits the core, right? That's why it's called core satellite approach. So a core means that you have a benchmark, and then your satellite that's orbiting is your active strategy, right? That's how you think about it. Alpha beta separation approach, we already mentioned this. We separate the alpha beta, and then we determine which portion is alpha, which proportion is beta, right? And it makes a more transparent fee payment for the passive strategy. Okay, so this is just a depiction of how a core satellite strategy could work. So you do an ETF, and then you might do, let's say, your satellite. So let's say your ETF, right, is your core, your diversified ETF, your, let's say, S&P 500, and then you do individual, maybe stocks or individual like specific ETFs, which could be a satellite, right, that orbits your core. This is some depiction for you to understand how do you find the alpha, true alpha. Okay, so this component of smart beta is not really in your syllabus, but I just want to highlight to you that it is something that is being talked about in the market, especially now that we are talking a lot about robo-advising, we talk about AI, and so this thing of smart beta is coming about. I want to repeat again, it's not really in your syllabus, right? So the idea of smart beta is that we are not, because we know beta is so hard to find, so now we're trying to find, no, sorry, alpha is so hard to find, right? So now we're trying to find a beta that gives us a bit more return than the actual beta. So this is called like smart beta. And how do we get this? We use very strategic moves like all these things we talk about weighting, fundamental weight. We do a lot of things, right, to the portfolio to get this slightly additional return, which is called smart beta. So smart beta seeks to outperform, right, the market return merely by mimicking the performance of the market cap weighting index. So you just do some small adjustments here and there, right? That's your smart beta. And this is how we can think about what smart beta is. And so this is your passive side, your active, and then this is your in the middle, right? So just some concluding remarks to think about your investment style, your investment strategy. Yes, it's very hard to beat the market all the time. Market timing is very important, when to go in the market. Of course, behavioral bias. So this is a quick summary of what to think about, your biases, your information that you have, historical data, whether historical data is reflective. Remember, we talked about a case where the person only go to one store. So is this representative? So things to think about. So being a contrarian can be appropriate. So now the market is going down. Maybe it's good to go in the market, right? And of course, what do you think about interest rates and inflation? Last but not least, as I mentioned, I feel that passive investing or ETFs or having a basket is the best because you are, first of all, diversified and you don't need to put in too much effort. And actually what they found is that most active managers do not really make a lot of money out of their investments because of the high cost involved, right? But at the end of the day, like what I mentioned in the first lecture, we should advocate for active investment. If not, there is no point of having a portfolio manager as a job, right? Because the point of portfolio manager is to manage your fund actively. So if anyone say, should you do active or passive, the politically right answer is always do active, but we know that actually at the end of the day, maybe passive is better. Okay, and I think that's all for today. And if there's any questions, feel free to stay behind. You can ask me. You can type in the chat now. For those that need to run off, yeah, that's all for today. Thanks. All right, thank you. Yeah, most welcome. Have a great Friday, TGIF to all of you. Yeah, have a great weekend. Thank you.